Jerome Powell and the Federal Reserve began their rate cutting cycle about a month ago when they cut rates for the first time in over a year. And we're now seeing a 97% chance that they're going to continue to cut rates on October 29th. Now, this is interesting because when we think about changes in the interest rates, we typically also think about inflation. And right now, inflation is still above the Fed's 2% target, sitting at about 2.9%. But the Fed is still cutting rates anyway. Why would this be the case? And this is something Jerome Powell has made clear. The Fed has two goals. Yes, one is to keep inflation tame, but the other is also to support the job market, which has been hurting lately. But now on top of this is incredibly bullish for stocks. But even more so, it's bullish for dividend stocks in particular. You see, investors love risk-free returns. But as that risk-free rate goes lower and lower, they're forced to get into the equity market, which is what boosts dividend stocks. So in this video, we'll be looking at 2 dividend stocks you can add to your portfolio before rate cuts, and also a dividend stock you really need to avoid. So let's go ahead and dive in and start with our first one, which is going to be NextEra Energy, stock ticker NEE. Currently trading at about $84.41, and in the last year, it's pretty flat, down by about 2%. So it's missed the broader market rally. But if we look at them year to date, they're actually up about 17.74%, with the last month being up about 16.32%. Now, this is interesting. Look when they started climbing in their share price. It started right around September 17th. Ironically enough, that's the exact date that the Fed started their rate cutting cycle. There's a lot of correlation that this stock has with interest rates and for a few different reasons. Now, obviously, that's not the only thing going on. The underlying fundamentals play a major role, but interest rates also impact the underlying fundamentals, and we'll see why here in just a moment. If we go ahead and look at NextEra Energy's dividend stats, we'll plug in NEE. You can see all this data will automatically load in. And like always, if you'd like to download any of my spreadsheets and get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, we can see NextEra Energy is yielding around 2.62% with a phenomenal history of dividend growth. Look at this, in 2014, paying out about 73 cents per share, 2024, $2.06, now around $2.21. So the 10-year dividend CAGR is actually above 11%, and the 5-year is right at about 10%. Now, this becomes even more impressive when you actually consider what type of business this is. More than anything, NextEra Energy is a utility company. And utility companies aren't typically known for growing earnings and dividends at a healthy rate. But NEE is certainly the exception. Now, one of the things we have to keep in mind when we look at utility companies is they're often capital intensive and have to carry and take on lots of debt. They have high capital expenditures. Because of this, we don't pay as much attention to the free cash flow payout ratio when it relates to dividend safety. We pay more attention to the earnings payout ratio, which appears to be in a good place, currently sitting at about 60%. I think that's fairly healthy for them. Now, the fact they have heavy capital expenditures and take on a lot of debt is significant as it relates to interest rates, and we'll get to that in just a moment. But we can see the 2 main business segments for NextEra. We have the Florida Power and Light business, which is about 70%, and then we have NextEra Energy Resources, which is a little bit more than 30%. And if we look at their track record, it's pretty impressive, again, for a utility stock. Adjusted earnings per share has grown at about a 9% CAGR over the last 20 years. Dividends, about a 10% CAGR. Operating cash flow, around 8% CAGR, which not only outperforms their sector S&P utilities, but it actually outperforms the S&P 500 on a total shareholder return basis. So how is NextEra Energy going to be impacted from interest rates getting cut even further? Well, again, we have to remember their business model. NextEra Energy, like I stated, is a utility company. So what does that mean? Well, if we jump over to our stock screener, let's go to the quarterly data tab, and instead of looking at the gross profit ratio, let's look at capital expenditures to revenue ratio. And thanks to ticker data, the data will load in. And we do have a few outliers we can see here in Q1 of 2019 and in Q1 of 2022, but overall there's an underlying trend here if you pay close attention. Look at this. About a decade ago, CapEx to revenue was in that 20% range for the most part. But if we look at the last few quarters, it's actually been closer to 40%. So this ratio has nearly doubled. And keep in mind, increased capital expenditures means they're probably taking on more debt. This is when lowered interest rates becomes very important. For example, take a look at the interest coverage ratio for NEE. We can see it was actually declining as interest rates went lower, especially during 2020, but then as interest rates increased, it actually surged to the highest we'd seen in over a decade. And again, the interest coverage ratio is essentially telling us how many times over a company can make its interest payments. So as they take on new debt with lower interest rates, it should become easier to cover those interest payments, especially with earnings projected to grow at about 6 to 8% like the company has stated. So that's great news for the company, but it also doesn't answer why CapEx to revenue has essentially doubled in the last decade. But NextEra Energy does answer this in their investors presentation, or at least they allude to it. The AI race is expanding, and as a result, so is data center demand. And this means there's a lot of demand for energy, which is where NextEra Energy comes into play, obviously. And so NextEra Energy is certainly positioned to benefit from this. NextEra Energy believes that over the next decade, the demand for energy will exceed the demand growth seen over the last 3 decades combined. This is very bullish, again, for NextEra Energy. So now we just have to talk about the valuation. Is there more upside? Well, let's go ahead and run them through our valuation models. Again, this data will load in. Now, because this is a utility stock, we definitely don't use the discounted cash flow analysis. In fact, probably the most valuable valuation we can use would be either the multiples valuation or the dividend discount model. Now, the caveat to the multiples valuation is while there are some companies somewhat similar in structure to NextEra Energy, we have to keep in mind I think they're growing earnings, and they've historically grown earnings at a faster rate, which means they warrant a higher multiple valuation. But we can see if we took the average of these 3 comparable companies and used their average PE multiple and applied it to NextEra Energy, they'd be worth around $85 per share. Now, again, that's pretty close to the current share price, but if NextEra Energy is projected to grow earnings at a faster rate, they absolutely warrant a higher multiple, and we actually see this with the dividend discount model. If we look at the dividend discount model and just assume a 6% dividend growth rate moving forward, which keep in mind historically they've easily achieved this, and if earnings are projected to grow at a rate of about 6 to 8% moving forward, this is certainly sustainable moving forward. But with a 6% dividend growth rate, you'd come to a fair value of close to $94 per share, close to about 11% higher from the current share price. So if we jump over to the output tab, let's zoom out just a little bit. Yes, if we average them together, fair value is about $89, but I absolutely think they warrant a bit of a premium. So let's just assume we don't use the multiples valuation. Even with a 10% margin of safety, it appears that they're actually within our acceptable buy range. So NextEra Energy, multiple catalysts on the horizon. Now we'll take a look at a high yield play, Alexandria Real Estate Equity, stock ticker ARE. And yes, this is a high yielder. If we plug in the stock ticker, and we can see they're currently yielding around 6.8% with a 10-year dividend CAGR of 5.64%. That's a very impressive combination, high yield with pretty decent dividend growth for a high yielder. Now, if you're looking at the payout ratios, you're probably concerned, and understandably so, but we have to remember this is a real estate investment trust, and the way we assess their dividend sustainability is far different than most other equities. So let's take a lot of things into consideration. To start off, this REIT has really struggled in the last year, down about 33.5%. Year to date, down about 20.25%. So we need to do things like assess why is this the case? What's the catalyst when it comes to interest rates? Why is that good for them? And is that dividend sustainable? Now, over on Dividendology.com, there is a link in the description, but I've been building a database of asset classes like REITs, business development companies, and covered call ETFs. And the reason I'm doing this is because there's a lot of data for these asset classes that is incredibly hard to get. So every single month, I've been compiling and crunching data on these asset classes. And if we take a look at the REIT database, we can see Alexandria Real Estate Equities right here. And this is one of the worst performing REITs out of all the REITs in this database, at least over the last year. But what's interesting about this is if we jump over to the historic and projected AFFO payout ratio. Now remember, AFFO stands for Adjusted Funds from Operations. It's pretty much the North Star metric when it comes to REITs, like earnings per share or free cash flow per share would be for your typical stock. But this is what we want to look at when it comes to earnings sustainability. What percentage of adjusted funds from operation are they using to pay out dividends? And for REITs, we typically want to see below 80%, and Alexandria Real Estate Equities has certainly been below that range. They've been in a very healthy range over the last few years, despite the REIT struggling, and they're projected to stay in a healthy range, it looks like, as well. So based purely off those numbers, it looks like the high yield is certainly sustainable. Now, one of the things we have to make note of is adjusted funds from operations on a per share basis is projected to grow at a relatively slow rate moving forward. So I wouldn't expect quite as much dividend growth moving forward. But again, keep in mind you're getting that nice starting dividend yield of around 7%. So how are they going to be impacted by changes in interest rates? Well, there's a couple of things we have to take into consideration, and the first is fixed rate debt versus variable rate debt. Now, for Alexandria real estate equities, they actually have very little variable rate debt. I believe it's around 3 to 4%. So while decline in interest rates can help them a little bit in that way, the real catalyst when it comes to interest rates is how investors look at them through the lens of opportunity cost. For example, again, investors love risk-free returns. I have a high-yield savings account with public.com. There's a link to it in the description, and for the longest time over the last year, it was yielding about 4.1%. Now, what's interesting about that is if we look at the historical yield for ARE, we can see there's multiple points throughout 2024 when it was yielding about 4.1%. But the problem is you're taking on risk by investing into equities. Some investors don't want to do that. They want to get their yield risk-free. What this does is it pushes capital away from assets like REITs, which causes the share price to go down. But now we're seeing the opposite happen. As rates are starting to get cut, as they continue to get cut, those risk-free returns are going to continue to go lower as we've seen in the last few months. And this is going to push capital into REIT markets, especially as investors continue to look for yield. And so with a yield of close to 7% and sufficient dividend coverage based on their AFFO per share, you can see why investors would be interested in Alexandria real estate equities. So if ARE moving forward can grow their dividend at a rate of just about 2%, close to in line with their future AFFO per share growth, combined with the fact that they have a low payout ratio, this should be somewhat sustainable as long as things continue to go well. We can see they'd have about 7% upside from their current prices. But on top of that, you get to combine that with a very nice starting 7% dividend yield. So those are two stocks that have the interest rate cut catalyst that they're set to benefit from. But what are the stocks that we need to watch out for? Well, during a declining interest rate environment, we have to be incredibly careful when investing into business development companies. Again, I built out a Dividendology BDC database for my members over on Dividendology.com. Now, what is a BDC? Well, BDCs are companies that typically lend to middle market companies using floating rate loans. Now, the key there is floating rate loans. What this means is they generate most of their net investment income from those loans, but if the rates are going lower because they're variable rate, that means their net investment income is going to fall as interest rates decline. Now again, remember, these companies typically have large dividend yields. Look at this, 9%, 14%, 12%, 11%, 15%. I think you get the point. But the question is, how sustainable are those dividends if their net investment income is going down? Well, we can look at the base dividend coverage. Again, I update all this data every single month on Dividendology.com. But for example, Ares Capital Corporation, yes, the yield is about 9.4%, but their base dividend coverage is only about 102%. If we look at their variable rate debt, it's around 83%. They're going to be highly impacted by changes in the interest rate environment, which means net investment income comes down, which makes the base dividend coverage number a little bit scary. So you don't have to avoid the BDC market as a whole, but you have to be incredibly careful when investing into this asset class. Now again, BDC data is incredibly difficult to get. Most softwares like Seeking Alpha, which I do love, don't provide it, which again is the exact reason that I built out this database and update it every single month. So watch out for the BDCs that have low base dividend coverage, have high levels of variable rate debt, which is most of them, because the net investment income for this asset class is about to be largely impacted. So there you go. Those are two stocks set to benefit from interest rate cuts and really an asset class as a whole that's going to be heavily impacted. Like always, if you'd like to download any of the spreadsheets that allow you to automatically import stock financials directly into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.